I now yield to Congressman Jones from North Carolina.
Mr. Chairman, thank you very much, and thank you for holding this hearing. I want to thank the panelists. And Mr. Chairman, about a week ago, I decided that the frustration of the American people in the 3rd District of North Carolina, which I represent, was so great, and their disappointment in the United States Congress and things we've done, talking about both parties, that I would take it upon myself to say, if you'll help me with questions for the panelists for this whole year, I'm delighted to be on this subcommittee, by the way, that I will use some of your questions when the panelists, my time comes. So, Mr. Chairman, in a week's time, we got over 1,000 emails from my district. I'm going to read 2, then I want to get to a point. Our Congress members, for the most part, must be the most financially illiterate group of men and women on the planet. Why would they need a study group on domestic monetary policy and technology to figure out you don't print more money to create jobs that are backed by virtual money or funny money? I believe we need to fire all these people and get a couple of housewives who have been managing their family budget over the years without credit cards, lines of credit, and other creative ways to rob Peter to pay Paul. This is a great example of how frustrated the American people are. That's why I do think this hearing today is important. Let me read the next one, then I want to get to the question. As an owner of small businesses and a family borrower, I have not understood how the Federal Reserve can keep its interest rates at almost zero and make lendable funds more available to the banks, while at the same time the banks have increased interest rates, decreased lines of credit, and restricted availability of loans to high-rated creditors like my businesses and other households. I can only see that the banks have improved their financial position on the backs of small businesses and families. That basically is going to be my question. I am very frustrated. I'm sure my colleagues in both parties are as well. What you hear back home is this issue of how the banks have been empowered with the Federal Reserve and the other agencies so that they are able to swell their financial state, and at the same time they're saying to those of us who are creditors, we're going to raise your interest rates on your credit cards, we're going to deny you loans because we have a certain criteria now. And this is why this country is in deep trouble, and it's going to continue in deep trouble. And that's why I think it's important that we hold these hearings about monetary policy, because the average American is out there strangling to death because of things that we do and don't do here in Washington. How would you answer the question to that constituent that wrote me that question? Anyone would like to answer?
I think your constituent ought to be made a member of the Council of Economic Advisors or something. It wouldn't be any worse than it is now, maybe a little bit better. Why are interest rates for the ordinary, why are people not borrowing a lot of money now? Is it because, the reason, of course, is why are businesses sitting on $2 trillion in cash, roughly, right now? They're sitting on $2 trillion. You can have interest rates don't matter. I mean, I don't say they don't matter. They're not the key thing. They're scared. Big people are scared. They're scared of $4 trillion increase in the federal debt over the last 3 years. No one, the housewife may not be sure why that's bad, but she knows that that is basically not a good thing to do. She knows that printing money and dropping it out of airplanes, or the equivalent, which is what the Fed does, will not create jobs, will not create wealth. It might temporarily lead to some behavioral modifications that leave the appearance of some stimulus in the short run, but not in the long run. I happen to like Abraham Lincoln, by the way, and I went to the Lincoln Memorial today to read the Gettysburg Address, and I noticed that they have torn up, that they have drained the reflecting pool. And there's a sign in front of it that says this is part of the stimulus, whatever, the reinvestment, I don't remember the name of that thing, Reinvestment Act, and they also had a sign next to it that says we're going to fill it back up again. You know, we can drain the reflecting pool and fill it back up again and probably put a few people to work for a day or two, but that doesn't create jobs. People are scared. And banks have partly raised interest rates, to get more specific, on some types of credit because they feel they have to because of the Dodd-Frank bill. Another thing, you know, when they see light at the end of the tunnel, you add on more tunnel. Not you personally, Congressman, but your colleagues. Add more tunnel. And we have added more tunnel. So we have the Dodd-Frank bill that has all kinds of new restrictions on banks and financial institutions. They got to make up the money somewhere. They're not going to just simply say, oh, we're going to let our profits fall to zero. We're going to become a charitable institution, a not-for-profit. That's not the way banks operate. So they've raised a lot of fees and so forth. So that has added to the frustration.
Would you like?
Yeah,
Dr.
could
Blevins?
could I have a very quick response to that as well?
The chairman.
I'll say one thing. If you look at the survey of small businesses, the National Federation of Independent Business, recently, over the past year, you asked them, what is the #1 problem facing you? Overwhelming, highest response in history, sales. There's no customers. And so then the question is, can monetary policy actually create some customers for those businesses? And it absolutely can. I mean, when you saw the ability to refinance mortgages at 4%, that freed up a lot of money for households. When you lower interest rates up and down the term and risk structure, you make it much cheaper for businesses who are on that razor's edge. Should I borrow a little money to expand? It's uncertain out there, but you make it much easier for them to do that. And the idea that there's inflationary expectations driving up long-term rates, there's just not. I mean, the clearest indicator of inflationary expectations that economists use is the TIP spread, the spread between inflation index treasuries and nominal. That was at historically low levels a couple months ago. Now it's still below 2%, lower than it was at any point during the 2000s. There's just no sign that inflationary expectations are out of line, and that's what's driving anything like long-term rates rising. And then just one last thing. I am no defender of the banks. But actually, if you're worried that banks are having too easy a time by borrowing cheap short-term from the Fed and then raising long rates on what they're lending to their customers, quantitative easing actually squashes that spread. It actually makes it less hospitable for banks to do that. So if you don't like the banks kind of riding the easy term structure created by what the Fed is doing to short-term rates, you should like the quantitative easing program.
Thank you.
Is there time for one more comment on that, or can I? Well, I would add, since I've written 3 books that include a history of banking, and so contrary to what Mr. Clay had to say, about me, what we've been experiencing is what economists call regime uncertainty. With all the uncertainty of the Fed changing policy month by month, the threat of huge taxes for socialized medicine, the re-regulation of banking with the Dodd-Frank bill, businesses sit back and wait because there's so much great uncertainty about the future with all these regulatory changes and tax changes. And that's one of the things is keeping them from lending to businesses. The businesses are putting a lot of their business plans on hold. And the economist Robert Higgs is best known for research on this whole area of regime uncertainty. And I think that's an important thing to factor in here.
I now yield 5 minutes.